Hello, today we want to look at Introduction to Group Accounts. In professional accounting, a group is made up of two or more entities or businesses under the control of one entity. The controlling entity is normally referred to as the parent company, while the controlled entity is referred to as the subsidiary. Assume that in the example we are looking at now, there is a company, and this company that is before us has acquired 100% holding of a subsidiary. In this case now, we do not have any non-controlling interest. All the companies here or just the company here is under the control, 100% under the control of the parent company. So what do? The name of the company will come in first, called Acri PLC. Acri PLC Group. Then you say consolidated statement of financial position as at, because it's a balance sheet, as at 31st of December 2017. Then you start by looking at the assets of both companies. You look at the asset of the parent, you add it to that of the subsidiary, you have 350,000. Property, plant and equipment is 350,000. Then you give a space for goodwill, because you don't know if you have a goodwill or a gain. So we are going to keep a space there and then add our current asset. We add the current assets of parent and that of subsidiary, and that will give us what? If you add the two, you have 200. You have your 200 there, but you have kept space between 200 and 500 for the goodwill if eventually there was a goodwill. Then you go to your equity. The equity, now you bring in the ordinary shares of parent only, which is 400, and then you bring in retained earning, but retained earning will have to be worked. So you put in your working 2 there, since your working 1 will be your goodwill, and you bring in non-controlling. At this point we don't have any non-controlling interest, but it's good to place it in there. Then you bring in your liabilities, adding the 2 trade payables. If you add the 2 trade payables, you have 50. So halfway you are done with your consolidated financial, you start preparing your goodwill, working 1. Your goodwill now will be bringing your cost of acquisition. From the question, our cost of acquisition is 200,000. Then you bring in your NCI. There is no NCI in this case. And then you bring in your net assets acquired. The net asset acquired will be ordinary shares of the subsidiary, which in this case is just 40,000. Then you bring in your pre-acquisition retained earning, the one in additional information. You bring it in, and that is about 50,000. Total will give you 90,000. Since there's no fair value adjustment, you less 90,000 from 200,000 to get 110,000, which is your goodwill. Since the 200,000 is greater than the 90,000, you have a goodwill. If the net asset was greater, we would have had a gain on purchase bargain. We'll look at that later. So we now prepare our working 2, which is the consolidated retained earnings. So the consolidated retained earning, you bring the retained earning of parent, you bring that of subsidiary, and you less the pre-acquisition retained earning. The retained earning of subsidiary at this point is 60,000. Pre-acquisition retained earning was 50,000. You less that, you have what? 10,000. We are lessing it because it's a retained earning. If it was a retained loss, we would have added. Then you bring it in, and then you add up all your figures. Your account is balanced, 100% acquisition, and then retained earning. Let's look at another scenario where the asset, the cost